Hello, my name is Rebecca McPherson, and this is our quick info session about estate tax planning. In this session, we'll talk about different aspects to estate planning, the way the government taxes estates, and some smart ways to mitigate estate tax liability. Let me introduce you to our example for this session, Betty Smith. Betty Smith came to us a few years ago asking our advice for her estate. Her husband Frank had just passed away, and Betty had their estate assessed. And at the time, her estate was worth approximately $30 million. And it was comprised primarily of real estate, a partial ownership of a few businesses, and investments. Betty has 4 adult children, 10 grandchildren, and is expecting her first great-grandchild in the spring. She's always assumed that her heirs would have to pay significant estate taxes when she dies, but she wants to make sure that she has found ways to decrease this liability to protect her wealth for her grandchildren and her great-grandchildren. So let's talk about some ways that we can advise Betty regarding her estate. First, what are estate taxes and who has to pay them? Are there other taxes that might come into play? Well, estate taxes are federal and state taxes that are levied against a person's estate after he or she passes away. The TCJA, the Tax Cuts and Jobs Act, raised the exclusion from $5 million per person to $10 million per person. And after inflation, this was adjusted to $12.06 million in 2022. Right now, there are also 11 states that levy estate taxes, and there are 5 that have inheritance taxes. And Maryland has both. So if you're not planning carefully, that bill could be pretty hefty when that person passes away. There's also something called the gift tax. This is a federal tax on transfers of money or property to other people while getting nothing or very little in return. This is triggered by gifts over $16,000 per person. But every person has a $12.06 million lifetime exclusion. So gifts over $16,000 won't necessarily trigger any gift tax at the time, but instead the difference is taken against the lifetime exclusion. Notice that the lifetime exclusion matches the estate tax exclusion. That's because the gift tax exemption used during your lifetime reduces your estate tax exemption upon death. So if you give a gift of $2 million, the difference would be taken against your estate tax exclusion at the end of your life. Lastly, there's another tax called GST tax. This means generation skipping transfer tax. This applies to payments made to people that are 2 generations below, so essentially grandchildren. These gifts are also part of that $12.06 million exclusion. So gifts that exceed your yearly tax-free gift will chip away at the exclusion as well. So we have to be smart about how we do gifting. But something to know is that when a spouse passes away, if they haven't used any of their tax exclusion, they can pass that along to their surviving spouse, which would increase the surviving spouse's exclusion to double, essentially. So Betty's estate tax exemption is now $24.12 million. So what are some things that we can tell Betty regarding her estate? So there's actually a few really, really easy ways that she can decrease the value of her estate without using up her estate tax exclusion. The first is through different gift-giving opportunities. So Betty has 4 children and 10 grandchildren that she could give cash gifts of $16,000 to every year without triggering the gift tax. That's $224,000 per year. She could also pay tuition and medical expenses as long as the payments are made directly to a provider, because those won't be treated like a gift then. So if she pays her grandchildren's tuition to college, as long as she makes those payments directly to the college, won't be treated as a gift. She can also gift property. One of the best ways she can do this is by gifting property with the greatest future appreciation potential. This will reduce her estate without really reducing the value of the estate, because she's giving it as a gift to someone that would have been receiving it potentially. She can also make donations to charities. Donations to charities are not treated like gifts because these are called charitable contributions, and it might even help reduce some of her income tax liability. Something else she could do is gift business interests. So gifting business interests is a little bit different. Sometimes your business interests can be eligible for valuation discounts due to lack of control, minority share, lack of marketability, or future interest discounts. These kinds of discounts can range from 10 to 45%. So if you factor that into the business interest gift, you may be able to gift a larger share of the business without surpassing the tax-free limit. You can also gift interest in a family limited partnership. So something that she could do is set up a family limited partnership and then fund the FLP with assets like stocks or real estates, and then gift interests to the FLP. You just have to make sure that if she does set up an FLP, that it's set up carefully and operated properly, because these will be scrutinized by the IRS. So you don't want any funny business going on there. The next thing she could do is she could set up different kinds of trusts. These are a super popular option because it protects the assets and ensures that the person that is meant to receive them receives them. So there's a couple of different very beneficial types of trusts that Betty could set up for her grandchildren or her own children. One would be a qualified personal residence trust. The qualified personal residence trust transfers the residence out of her name and places it in the name of the trust. This would also allow her to stay in the home for a specified period after the trust has been put into effect. And then she could rent it to the eventual heirs, or she could renew the trust after a certain period of time, or if she passes away, then it wouldn't be considered part of her estate. Another type of trust would be the grantor retained annuity trust. A grantor retained annuity trust transfers income generating assets like stocks or business interests, bonds, real estate into a trust, and then she would receive payments from the trust over a period of time instead of having those income generating assets as part of her own estate. They would belong to the trust. Lastly, another kind of trust that she could set up is something called a dynasty trust. Now, you know, Betty has 10 grandchildren and she's already got great grandchildren on the way. This would be a really good option for her to make sure that her children and grandchildren are taken care of without giving them full access to every asset. So the trust operates just like a standard trust and can make payments as desired for the beneficiary's health, support, maintenance, and education, and it can last for the entire life of the child or the beneficiary. At a certain age, a lot of grantors choose to have the beneficiary serve as his or her own trustee, giving the beneficiary control over investments and distributions, and it can provide for future generations. It can shield trust assets from each generation's creditors, like in a divorce, and it can enable a portion of the trust to escape estate taxes otherwise due on the passing of each succeeding generation. So, can we help Betty protect her assets, but also protect her from estate tax liability? Of course, we can help her. We have a lot of options at our disposal. Primarily, we want to advise her on her gift giving. We want to start setting up trusts. Those are going to be ways that we protect her assets for future generations without her losing any of the benefit of these assets that she's worked so hard for her whole life. Does anyone have any questions? All right, I hope you all have a wonderful day.